And the unit economics in the 2010s looked phenomenal, and like growers were making money hand over fist because the Chinese economy was booming. The Chinese consumer was, well, wealthy and getting more wealthy, and cherries and the color red are a sign of prosperity. And that led to a lot of cherry buying, which is a pretty good situation for the growers here. It almost feels like blueberries maybe back in the 90s when there just wasn't that much supply. During the 2010s, it was a bit of an arms race, and you saw a lot of growers putting a lot of trees into the ground, trying to scale and grow and dominate that market because the unit economics were so attractive, some of the best in farming that I've seen. Now, that was all well and good until COVID. The COVID era really was the start of a series of unfortunate events for the cherry industry. You had, well, COVID itself, which was a major challenge in terms of finding labor and getting them into the country during the 2020 production year. We also had a big stint of wildfires, which didn't really affect the trees per se, but it can make it challenging for labor who have to work in smoky conditions. And that was followed up by 2 absolutely brutal winters with killing frost events where the temperatures in the Okanagan dropped to about -30 from having been in the low positives, only hours before. And that kind of change is just brutal for tree buds. And you saw basically close to 90-95% loss of fruit production 2 years in a row. And for farmers who had been levering up and using bank debt to plant and scale their businesses, that's a big problem because they have no income. And for some of these guys who are vertically integrated, that's even worse because there's crop insurance for the grower, but there's no crop insurance for the packer processor. And well, those pack houses are not cheap, and the bills still have to get paid even though you have no fruit to push through your lines. So that's been tough. So in coming into the 2026 season, 2025 was good. Production was high, but prices took a bit of a hit because of a lot of the trade fluctuations that were happening with the Trump administration's tariff war, really impacting the ability of growers to kind of access usual markets. And it was a big bumper crop, and that overproduction just led to kind of weaker pricing. So it wasn't as lucrative a year as guys hoped for, and coming off the back of 2 basically zeros, that's tough. So in 2026, there's a lot of need for refinancing and deleveraging. And for us at Shire, I mean, that's kind of exactly what we would hope for and why we wanted to be positioned in this space, because we saw this coming, where you had this whole wave of smaller, older growers that really needed a succession plan and a way to finance it. And in an area like the Okanagan, where the supply is quite limited, to us, it made sense to start to consolidate some of these assets because, well, functionally, you just have more market share and a meaningful market share in a niche product that you actually have some influence over. So, we began acquiring and accumulating in 2022, and really into the stress years, we kept buying. And we really think that we're well positioned now. We're in a good spot. We have really good partners, and I think the opportunities are emerging. Shire Farm Partners LP2 now holds 4 orchards in the Okanagan area, about 100 acres total. And we're really happy with it. We basically kind of surround Kelowna north, east, and south. And it gives us a nice spread of properties and some pretty valuable real estate. Relatively small parcels and very well located. So generally these are properties that have high demand.